1 week ago, silver was barely part of the conversation. It was trading quietly in the low 30s, exactly where it had spent most of the past year. Analysts described it as stagnant. Portfolio managers treated it as a footnote. Retail traders ignored it entirely, preferring assets that promised excitement, volatility, and fast returns. In an era dominated by artificial intelligence stocks, crypto narratives, and exponential growth stories, silver felt like an artifact from another time, a metal associated with coins, jewelry, and old monetary systems, a hedge people talked about but rarely acted on. Then the price detonated. In just 7 days, silver didn't merely rise, it escaped. From roughly $32 per ounce to nearly $80, the move shattered every assumption about how modern commodity markets are supposed to behave. This wasn't a rally. It wasn't momentum. It wasn't speculative enthusiasm. It was a forced repricing, and that distinction matters because forced repricings don't end gently. They happen when markets realize something they were never prepared to admit: that a resource, once assumed to be abundant, is no longer guaranteed to exist in sufficient quantity at any price. Silver didn't double because investors suddenly loved it. Silver doubled because the world discovered it needs it, and there isn't enough. This is not a story about charts, traders, or technical indicators. This is a story about physics colliding with finance, about geology colliding with government policy, about a digital economy discovering, very abruptly, that it still runs on physical materials pulled from the ground, and the consequences extend far beyond the silver market itself. Because silver sits at the center of nearly every major industrial, technological, and energy system that modern economies depend on. When its price breaks, it sends shockwaves through supply chains, corporate balance sheets, equity valuations, and ultimately the entire stock market. To understand why this moment matters, and why its effects will likely be larger than most investors expect, we need to start with a basic, but often misunderstood reality. Silver is not just a commodity. Silver is a constraint. Silver occupies a position no other material can fully replicate. It is simultaneously an industrial necessity and a monetary asset. This dual role creates a pressure dynamic unlike anything else in financial markets. On the industrial side, silver possesses a physical property that engineers cannot cheat, regulate, or innovate away. It is the most electrically conductive metal known to science. Not copper, not gold, not aluminum. Silver. That single characteristic makes silver foundational to modern civilization. Every time electricity needs to move efficiently, reliably, and with minimal loss, silver becomes the preferred, and often unavoidable, choice. Solar panels rely on silver paste to collect and transmit electrical current generated by photovoltaic cells. Without silver, panel efficiency drops sharply. Alternatives exist in laboratories, but in commercial deployment, they reduce output by 15 to 20% or more. In an industry already operating on thin margins and fierce competition, that efficiency loss can mean the difference between profitability and bankruptcy. Electric vehicles require silver across their entire electrical architecture. Battery management systems, power distribution units, onboard computers, sensors, charging interfaces, and safety systems all depend on high-conductivity materials. As vehicles become more software-driven and electrically complex, the amount of silver used per vehicle increases, not decreases. Telecommunications infrastructure, especially next-generation networks, consumes silver at an accelerating rate. High-frequency signals require superior conductivity to minimize loss and interference. Each new generation of network hardware uses significantly more silver than the last. Medical equipment relies on silver not only for conductivity, but also for its antibacterial properties. Surgical tools, imaging devices, water purification systems, and hospital electronics all incorporate silver because nothing else performs as well. Military systems depend on silver for hardened electronics, guidance systems, radar arrays, and secure communications. These applications are not optional. They cannot be substituted without degrading performance or reliability. Silver is embedded everywhere, and once it's embedded, much of it is never recovered. But industrial demand is only one half of the story. The other half is older, deeper, and far more disruptive. For over 5,000 years, silver has functioned as money. Not currency, money. Long before central banks, before governments, before fiat systems, silver served as a store of value across civilizations. Empires rose and fell, borders shifted, currencies vanished, but silver retained purchasing power across time and geography. That monetary role never disappeared. It was merely overshadowed during decades of financial abundance, globalization, and confidence in centralized systems. Now, as physical constraints tighten and trust in infinite financial solutions weakens, silver's monetary identity is resurfacing. At the exact moment industrial demand is peaking, the convergence is what makes silver uniquely dangerous to ignore. In most commodity markets, supply responds to price. If oil prices rise, energy companies drill more wells. If agricultural prices increase, farmers plant more acreage. If natural gas spikes, production ramps within a year or two. Silver doesn't behave that way. Roughly 70% of global silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. Mining companies don't dig holes looking for silver. They dig for something else, and silver happens to be in the rock. That means silver supply is not driven by silver prices. It's driven by the economics of other metals. If copper prices stagnate, copper mines don't expand, even if silver prices triple. If lead or zinc demand slows, silver output slows with it. This creates a hard structural ceiling on how quickly supply can respond. Even when prices rise dramatically, new silver production takes years to materialize, and new mines require discovery, permitting, financing, infrastructure, and development. A process that often takes 7 to 10 years under ideal conditions. And ideal conditions no longer exist. Environmental regulations have tightened. Local opposition to mining has increased. Ore grades have declined steadily for decades. The easy deposits are gone. What remains is deeper, lower quality, more expensive to extract. Meanwhile, annual silver demand has quietly climbed year after year. Industrial use now consumes the majority of global production. Investment demand, coins, bars, institutional holdings, adds another massive layer. Together, demand has consistently exceeded mine supply for more than a decade. For years, that deficit was masked by above-ground stockpiles. Governments sold reserves. Exchanges released inventory. Large holders quietly liquidated metal into the market. Those buffers are now depleted. The United States sold its strategic silver holdings decades ago. Other governments followed. Exchange vault inventories have fallen to multi-year lows. When buffers disappear, markets change character. Price stops being a signal. Price becomes a rationing tool. And rationing is violent. This repricing didn't happen randomly. It was triggered by a decision that received almost no attention at the time. Buried in regulatory language, ignored by mainstream media, overlooked by markets focused elsewhere. China, the world's largest silver refiner, announced new export licensing requirements for refined silver. On the surface, it appeared administrative. In reality, it reshaped global supply overnight. China processes a massive share of the world's mined silver into industrial-grade material. That refined metal has historically flowed to manufacturers in the United States, Europe, and other industrial economies. Under the new system, only exporters meeting strict capital, scale, and capacity requirements can ship silver abroad. Smaller refiners, which had supplied much of the international market, are effectively eliminated. The motivation is straightforward. China dominates solar panel manufacturing. It leads electric vehicle production. It is expanding grid infrastructure and electronics output at historic speed. All of those industries require silver. Restricting exports ensures domestic manufacturers receive priority access, while foreign competitors scramble for supply. Once markets understood this wasn't temporary, the repricing began. Hundreds of millions of ounces that once moved freely across borders were suddenly trapped. And this happened at precisely the moment industrial demand was accelerating. While supply tightened, something else had been unfolding quietly for more than a decade. Large financial institutions were accumulating physical silver, not paper contracts, not futures, physical metals stored in vaults. The strategy was subtle but relentless. Whenever silver prices showed signs of rising, massive sell orders would appear in thin trading hours. Prices would drop suddenly. Retail investors would panic. Mining companies would hedge production at depressed prices. Then, physical metal would be purchased quietly at a discount. This pattern repeated again and again. The paper market was used to suppress price discovery, while physical inventories were built in the background. Regulators eventually issued fines for manipulation, but the penalties were trivial compared to the value of the accumulated metal. Then something changed. The short positions disappeared. The pressure that had capped silver prices for years vanished. The entities that once fought rallies stopped selling. They were no longer suppressing price, they were positioned to benefit from it. When silver broke through long-standing resistance levels without intervention, the market recognized what had happened. The ceiling was gone. Speculators chase momentum. Industrial buyers chase survival. The moment manufacturers realized silver supply could no longer be guaranteed, purchasing behavior shifted dramatically. Just-in-time inventory models collapsed. Companies began stockpiling. Long-term contracts were signed at any price available. This created a feedback loop. Rising prices triggered panic buying. Panic buying drove prices higher. Higher prices validated fear. Silver didn't move in steps, it leapt. And now that silver has repriced, the shockwaves are spreading outward through the global economy. Commodity inflation doesn't gently reduce profits. It breaks assumptions. Entire sectors of the stock market were valued on the premise that silver would remain cheap, abundant, and accessible. That premise no longer holds. Renewable energy companies operate on razor-thin margins and long-term fixed-price contracts. When input costs triple overnight, losses become unavoidable. Electric vehicle manufacturers face rising costs at the same time consumer demand is slowing. Margins compress while growth expectations evaporate. Technology companies absorb higher component costs across hundreds of millions of devices. Even small per-unit increases compound into massive profit erosion. Defense contractors operate under delayed reimbursement structures. Costs rise immediately. Compensation comes later, if it comes at all. Stock valuations don't wait for earnings to collapse. They adjust in anticipation. Multiples compress when growth slows, and margins shrink simultaneously. And because technology, renewables, and industrials dominate major indices, the impact spreads quickly. Higher commodity prices also feed inflation data, keeping interest rates elevated. Elevated rates further compress valuations. Then comes forced liquidation. Funds exposed to commodity shorts face margin calls. To meet them, they sell liquid assets, equities. Selling creates more selling. This is how systemic stress propagates. Every major financial crisis of the past 4 decades reinforced the belief that governments can always intervene. Print enough money, cut rates, backstop markets. That belief holds until physical constraints assert themselves. You cannot print metals, you cannot legislate supply, you cannot regulate geology. History has shown this repeatedly. Energy crises, resource shortages, commodity shocks. Policy can influence demand, it cannot conjure atoms. Silver now sits precisely at the intersection of essential infrastructure and limited supply. Governments need it for energy transitions, defense systems, and technological leadership. But they cannot control it. That contradiction is now visible. Physical shortages don't resolve quickly. New mining supply takes years. Recycling helps, but only at the margin. Demand destruction comes through economic pain. Prices remain elevated until equilibrium is restored, and that equilibrium is far above previous norms. This doesn't mean silver rises forever. It means the era of cheap silver is over. Industries will adapt. Products will be redesigned. Some companies will fail, others will survive with lower margins. Markets will stabilize, but at lower valuations. And investors will relearn a lesson forgotten for decades. Claims on assets are not the same as assets. When scarcity arrives, ownership matters. Silver is not an isolated event. It is the first visible fracture in a system built on the assumption that physical inputs would always be available, affordable, and globally accessible. That assumption no longer holds. As energy transitions accelerate and geopolitical fragmentation increases, similar stresses will appear in other materials. Copper, nickel, lithium, rare earth elements. Silver simply arrived first, and markets are reacting accordingly. This is not financial advice, it is a warning. The digital economy still runs on physical matter, and physical matter has limits.